Welcome to video 4 in our series Principles of Equity Investing. Before I go to equity investing proper, I thought I would also deal with over-the-counter investment just to get a little more clarity in terms of how equity investments are distinct from some of these over-the-counter or OTC investments. What is over-the-counter investment or OTC investment? It is essentially a contract between two parties which is not widely known to others. Well, that way when we buy shares or sell shares, they are also not widely known to others. We do it in our own privacy. However, it does get reported somewhere. Whereas over-the-counter investments, there is no registry where it will get reported. It is completely between you and the other party. An example is a bank deposit. It's an over-the-counter investment. It is only known to you and the banker, right? It's not reported anywhere. So people feel more secure with over-the-counter investments because quite often there is no direct exposure to market price movement. People put a bank deposit, they don't have to worry about the principal amount invested going up or down, which is what is a risk or a perceived risk in equity markets. So this gives a great feeling of comfort to people, and they quite often gloss over the facts that there could be some hidden risks. Or sometimes people, because they need return, they get prompted to put money into such over-the-counter investments where the promised return could be very high, but it could be inviting them to hidden risks. So this is something that each investor should be very aware about, and I'm going to talk about some of the risks involved in the OTC investments in one of the later slides. So what are the examples of over-the-counter investments? One example which I already gave is the deposit with a bank or deposit with post offices, deposit with companies, deposit with non-banking finance companies, deposits with housing finance companies. All these deposits are over the counter. The contract is between you and the deposit taking institution. Purchase of real estate. Well, there is a certain amount of market movement that does happen in real estate, but there is no stock exchange kind of market where we all know what is the exact price which is prevailing in terms of real estate, because typically real estate cannot be so clearly standardized and there are always going to be variations from flat to flat. So purchase of real estate also remains like an over-the-counter investment. Provident funds, the money that we accumulate in public provident funds, company provident funds, all these are over the counter. They give us the security that our principal is intact. Endowment policies of insurance companies. Of course, it's a separate matter whether endowment policies are a good investment bet. No dispute about need for insurance, need for life insurance, but quite often investments have been missold by clubbing them with insurance policies, which is unfortunate because the return on such policies is very, very low. Unfortunately, people are not able to analyze that exact return, and a lot of mis-selling in this space continues to happen. By the way, financial services, banking products are very amenable to mis-selling, and we need to be very aware about them. Insurance is another area where mis-selling happens in a very rampant way. Quite often it is the interest of the agent or the intermediary which is the driving factor rather than what benefits the investor. But that's a separate issue. Maybe in course of time I'll also talk about other such conflicts in financial services industry. So what are the risks in over-the-counter investments? One risk which is not noticed by depositors is that the interest rates slide down. Let us say, for example, in a interest regime where over a period interest rates are falling, or as the economy, like India, from a developing economy becomes more developed and it becomes more mature, the interest rate regime is going to be more benign. Interest rates are going to fall, and by the time our time deposit matures, we realize that we're not able to reinvest at the same high rate that we were able to invest previously. So this is a risk which happens in over-the-counter investments. Credit default risk. That is, the party with whom the money has been entrusted defaults. Thankfully, in a country like India, public sector banks are backed by the government, because there is a lot of public money is at stake. So nobody has to worry about such kind of default. But people do experience this with cooperative banks or smaller banks where suddenly there is a scare and people are very worried about it. Another risk is of illiquidity, not being able to get out of that investment, blocking of funds. For example, this happens with Provident Fund, this happens with Public Provident Fund too. That money gets blocked for many years, and the alternative use that we should be able to have, we are not able to do it because we have taken advantage of certain tax reductions when we invested money there, and we have to live with that. So this is also a risk in case of over-the-counter investment. Sometimes that is also a risk in case of time deposits where we are not able to take advantage of other opportunities, because if you were to withdraw early, there would be some penal charges for early withdrawal, and that also creates this risk of blocking of funds or illiquidity. So, as investors, we need to be aware that there are risks in over-the-counter investments too, and that actually makes equity investing very attractive because it helps us to be agile in our investments. We are able to get out of the investments moment we feel there are some risks which are rising, which is not so easily possible in case of over-the-counter investments, and that's where equities scores. So do keep on encouraging me with your like button, and do press the subscribe button, use the playlist to take advantage of the content that I'm creating. Thank you.